was 7.2% compared to expectations of around 7%. This shows that the economy retained good momentum heading into the current financial year. In fact, we could even stick our neck out and say that when the first revised estimate for the financial year ending March 23 are released next year in February, we will be able to see even a further upward revision to these numbers, because as we pointed out last time when we spoke on the GDP data, the second and the third quarter numbers of the financial year ending March 23 were artificially depressed due to the base effect coming from the upward revisions to data starting from 2019-20. So that is what we are seeing.
Yes, very happy. More than we are also.
I request again to kindly mute your mics, please.
And that is what we are seeing in the data for the fourth quarter, when a year-on-year growth rate was at 6.1% compared to expectations that ranged all the way from 4% to 5.7%, depending on whom you look at. If you look at the granular data on growth in services, industry and agriculture, services sector growth has maintained its momentum. Industrial sector growth rate positive, but slowing compared to 22 because of the rise in commodity prices in the course of 22-23, and also the rise in interest rates. But the momentum in the fourth quarter, as you could see from the data, in terms of manufacturing growth, was at 4.5%, and the utility and the core sectors grew 6.9%. So overall, the manufacturing sector has ended its 2 quarters of year-on-year contraction in Q2 and Q3 and resumed a pretty brisk positive growth rate in Q4. Exports of goods and services as a percentage of GDP, as you can see from the top right, is at its highest in about 8 years at 23.5% of GDP. And the private consumption to GDP ratio is again at a high in the last 16 years. And gross fixed capital formation, while it is 34% of GDP, specifically looking at the fourth quarter, year-on-year, the share of GDP of GFCF, gross fixed capital formation, was 35.3%, and in nominal terms, it was 31.7%. So overall, as we have been saying, that the government's investment in infrastructure over the last several years is beginning to crowd in the private sector investment, as you can see in the new project announcements and also from the data released by companies on their own cash flow projections. Please mute your lines. I mean, it's difficult to speak if you are not able to mute your lines, please. Thank you. We have been saying it so many times since we began speaking. The growth momentum, as I mentioned earlier, sustained in the The growth momentum sustained in the fourth quarter of FY23 at 6.1%, fastest among the major economies of the world, which you can see on the right side. On the left side, we are showing the growth rates for each quarter in the financial year ending March 2023. So among the major economies, India's annual growth rate in the final quarter of the fiscal year ending March 23 was the highest, as you can see on the right-hand side. Going on to the next slide. In the fourth quarter, specifically, the growth momentum was picking up in industry, agriculture, and services. I again point out to you that the second and third quarter of the fiscal year in manufacturing showed a contraction, but reviving itself in the fourth quarter. And the investment rates, as I just now described to you, is at a high level of 35% year-on-year in Q4. And private consumption in Q4 might have dipped, but overall for the financial year, private consumption, a share of GDP, was at a high in about 16 years, as we showed. Addition components and looking at the state of the health of agricultural sector. The food grain production based on second advanced estimate for 22-23 is looking pretty good at 33 crore tons, 330 million tons, that is, or close to 300 million tons, I'm sorry, 300 million tons. And if you look at the middle top chart, the availability of water in reservoirs compared to 10-year average is 36% above the 10-year average in the southern region and more than 20% above 10-year average in the rest of the regions of the country. Seeds availability are plenty compared to the requirement, and there is adequate procurement of wheat in FY23. The sale of tractors continues to create double-digit growth rates, and therefore it augurs well for the growth of the agricultural sector. While of course many of us know that there is a prediction of an El Nino, but lately this prediction is being pushed back by meteorological agencies, which is good news for the overall development of the monsoon, and it soon should be setting in the western coast of the country. And fertilizer stocks are in comfortable position compared to the estimated requirement. If you look at the high frequency monthly data, PMI manufacturing has been expanding since the middle of 2021. And if you look at the index of industrial production and the core industries growth rate, naturally the chart looks somewhat on the flatter side simply because it is coming off a high base in Q1 of 21-22, but these growth rates are in high single digits or close to double digits in the case of the core in 8 core industries. Capacity utilization is expanding. In fact, in several sectors, it has already crossed 75%, which would necessitate either the expansion of existing capacity or creating new capacities in several sectors. Steel production and the index of cement production are rising, auguring well for construction sector and non-residential construction as well. Coming to services sector, starting from the top left, PMI services expanded at the fastest pace in 13 years in April. There is robust growth in ride-free traffic, which is also a good sign of industrial and manufacturing activity in the country. The hotel industry is doing quite well, as most of us would know who keep traveling. In fact, I understand from the industry participants that the total employment in the hospitality industry was 40 million before COVID, and during COVID it dipped to 29 million, and post-COVID recovery phase it has improved to 45 million in terms of employment, even exceeding the pre-COVID levels by more than 10%. And foreign tourist arrivals are now getting back to the average of the pre-pandemic level as we head into the new financial year, which has just started. And if you look at the private consumption, where in this chart, we plot the private final consumption expenditure pre-pandemic, and then the post-pandemic is the green line. And if the pre-pandemic trend had continued, where it would be is the red line that continues. And the post-pandemic trend is now catching up so well that it is exceeding the pre-pandemic trend line as well. So in other words, it is not as if we are lost permanently a certain trend growth in private final consumption expenditure. The acceleration in the post-pandemic period in the recovery of private final consumption expenditure has now caught up with what would have been the trend growth pre-pandemic had the pandemic not happened. In terms of rural demand, year-on-year growth in fast-moving consumer goods volume sales turned positive in Q4, signaling a pickup in rural demand, a very slight positive, but still a turnaround from the previous 3 quarters. And if you look at the agricultural and non-agricultural wages, on the right top, there is a blip on the upside, both in agri and non-agri wages in terms of the annual growth rates. And after moderating in February and March, the combined 2- and 3-wheeler sales picked up in April 2023. An increase in the minimum support price for major crops and a rise in the Mahatma Gandhi National Rural Employment Guarantee Scheme wage rate are expected to improve the financial security of rural households further and boost rural demand in the coming months. But more importantly, let me also point out that the index of cement and steel production showed us construction sector activity is pretty strong, as you will see later in the real estate sector trends. And therefore, much of the employment elasticity in the country comes from the construction sector. And that would also lead to migration of some of the workers who returned to their native villages during the pandemic to come back to urban India and resume their jobs in construction industry, etc. And that is also likely to contribute to income transfers from urban to rural India, and naturally resulting in consumption growth in the coming months and quarters in rural India as well. In terms of urban demand, passenger vehicle sales are picking up. And as you see on the right top, there is a pretty strong momentum in new launches of housing as well as sales. And domestic air passenger traffic in the financial year 22-23 had exceeded the trend in the previous 3 financial years. And also the spend on credit and debit cards are running at good rates. So overall, urban consumption demand is also growing quite briskly, as well as indications of strong recovery in the rural demand side, as well as we saw in the previous slide. Turning from demand side indicators to inflation management, while India did experience a spurt in the inflation rate in the first quarter of 22-23 because of the sharp pickup in commodity price due to the onset of conflict in Ukraine, by and large, India's deviation of the inflation rate from the target is one of the lowest, only beaten by Indonesia, whereas India is the one country after Indonesia which had the lowest deviation in terms of the inflation rate from its target. And the monetary policy tightening, therefore, didn't have to become extreme, and that is what, in a way, paves the way for a soft landing, which has already happened, and augurs well for growth prospects in the current financial year as well. As far as the inflation outlook is concerned, many of you would have already noticed the RBI annual report released earlier today, and overall the WPI inflation rate is actually in negative territory, and consumer price index is within the tolerance band of the Reserve Bank of India. As we expect commodity prices to remain somewhat subdued globally, I think the pass-through from WPI to CPI will also be restrained, and there is a very high chance that the consumer price index inflation rate comes back and closer to the RBI's midpoint of 4% rather than staying above 5% in the course of the current financial year. India's inflation forecast, therefore, excepting for ADB, all other forecasts are pointing on an average to a number that is at the midpoint of the range of between 4 and 6 on the upper end towards 5%. And the food and the core inflation both are also declining. Of course, some of us would point out that monsoon could be a risk, but that is where we showed that the irrigation levels and the estimates of production and the buffer stocks, etc., are all pointing to a lot of risk management, risk mitigation parameters that would keep any potential impact of a weaker monsoon, if it were to happen, on the price side and the output side muted. So inflation trajectory will be influenced going forward by the following factors: pass-through of lower input costs, bumper harvest, healthy prospects for Kharif season, and internationally, commodity prices are expected to decline in 2023, even if they are still higher in absolute terms than the pre-pandemic levels. Turning from domestic demand and inflation to external situation, merchandise export growth as expected, were lower in Q2 and Q3, but in Q4 it staged quarter-on-quarter recovery, even better than the Q2 levels, which is, I think, a good sign given slowing global demand, and that has contributed to a moderating merchandise trade deficit. But more importantly, all of us know that the surplus in services trade has been rising, which is what is contributing to a very subdued expectations of current account deficit, even for the current financial year, with many forecasters pointing to a number that will be less than 2%, that will be even better than 2% of GDP for the current account deficit in 23-24. And after some hesitation on the part of the foreign portfolio investors in the closing months of the calendar year 2022, they have returned to the Indian market, sensing the importance and the virtues of macroeconomic stability, higher growth rates compared to major economic powers, and overall financial and macro stability. And the forex reserves, which declined during the course of the last financial year, especially in the first half, are coming closer to the kind of peak levels we saw in April-May 2022, heading towards $600 billion on the back of a declining trade deficit and improving foreign portfolio investment flows. Well, all of us have been waiting for the capital formation in the private sector to pick up. One of the important leading indicators is the import of capital goods, even not more than the overall import numbers. We keep track of the import of capital goods, which actually did underperform in the second decade of last year, is the second decade of this millennium, which is what reflected in the low capital formation because of balance sheet problems faced by the corporate sector. But now in the current financial year ending March 2023, capital goods imports picked up quite well compared to the previous year, growing by almost 20%. And increased production of capital goods domestically and construction and infrastructure good index complement the growth in the import of capital goods, auguring very well for a pickup in the private sector capital formation, which is what we see in the new project announcements by the private sector, captured in many other private databases as well. And bottom-up data based on the financial results of companies submitted for March 2023 indicate that private sector capital formation is beginning to unfold. And as we get full data for the corporate sector in the coming months, we will see that it is no longer a prospective story, but a current reality, that the private sector capital formation cycle on the back of high capacity utilization and robust demand has begun to take place already. And as you can see on the right side, growth in private investment in several sectors in FY23 compared to FY22 are listed here, excepting the three sectors in the bottom. Every other sector has seen a healthy improvement in capital formation rates in FY23. Today also we saw the release of the fiscal deficit numbers. In fact, for the financial year ending March 23, in terms of 2 decimal places, it would have been 6.36%, but it is 6.4 in terms of first decimal place as budgeted and as revised. And therefore, we are on track on the back of sustained economic growth to achieve 5.9% budgeted for the current financial year. And that is why the continued emphasis on capital expenditure will also be expanding the potential growth rate of the economy, contributing to prospects for non-inflationary sustained economic growth in the remainder of the decade. And that is what is also signaled by the fact that financial cycle in India, which went through a downturn in the second decade, has also turned the corner, as we will see later, and a combination of better financial health in the banking and in the non-banking sector, and the infrastructure improvement contributing to removal of bottlenecks, and private sector capital formation catching up to meet increased demand, should actually augur very well for an elongated economic cycle in the country, than in the previous decades. On the fiscal front, of course, apart from the capital expenditure thrust, also the brighter picture comes from the improvement in corporate tax collections and in the personal income tax collections, both of which are growing neck to neck in terms of the actual tax collected, both from the corporate sector and from the personal sector. And on the indirect taxes side, of course, goods and services tax, the average level shift apart from the pandemic year has been noticeably sharper even in 22-23 and beginning quite well for 23-24 as well. In terms of labor market, the quarterly urban unemployment rate is down from a peak of 21% or 20.8 in the pandemic-induced, pandemic-heavy quarter of April-June 2020, down to 6.8% in the quarter ending March 2023. In terms of the creation of formal employment, based on the average net additions to the Employee Provident Fund organization, you can see that the FY23 average level has been much higher than the previous 3 financial years, and these are good indicators of the health of the labor market in India. And in terms of a start to the current financial year, we did mention in the monthly economic report which we put out, the April monthly economic report was released in the 3rd week of May, and we did say that while in the economic survey, we mentioned that 6.5% was our target or an estimate of the real GDP growth for this financial year, but we also mentioned that the risks to the downside were higher. But now we are prepared to stick our neck out one more time and say that the risks to 6.5% are probably more evenly balanced. That is, there is as good a chance that this number may be exceeded as there is a chance that the reality may undershoot this number. So we are prepared to say that the risks are more evenly balanced than what we felt 4 months ago, and the high frequency indicators for industry, services, external sector, fiscal and credit growth are all pointing to sustained momentum in the economy. Growth prospects therefore appear bright. External factors, as the RBI's annual report also indicated, pose downside risks because of geopolitics, because of what might happen to oil production, and also due to potential for further monetary tightening in some developed countries, and with it the attendant risks of further financial stress. But those are external factors which are well provided for in terms of the resilience of domestic demand growth in India. So our expectation is that private sector will continue to expand its investment plans. Public digital goods platforms will also keep expanding, along with last mile connectivity and logistics reforms on the back of the sustained investment in infrastructure, which has grown by 3 times through public capex spending. All of these provide important buffers against the external risks that we point out in this slide. The growth projection, just to share with you what each different agencies have, 6.5% is the estimate of Reserve Bank of India as well as the Ministry of Finance here. And RBI, the Asian Development Bank and the World Bank are quite close, whereas the credit rating agencies are at 6, IMF is at 5.9, and OECD is 5.7. But I reiterate, our number is 6.5%, and the risks are evenly balanced between the downside and the upside to this estimate. Thank you very much. So we are very pleased to have been able to present a story of both sustained economic momentum combined with macroeconomic, financial and fiscal stability, and we look forward to another year of solid economic performance by India. Thank you very much. Now I am ready to take your questions.
We begin with Arup Roy Chaudhary, Business Standard.
इंडिया में जहां आर्थिक मंदी है वहां भारत इस तेज गति से विकास कर रहा है। इस बुलेटिन में इतना ही, लेकिन न्यूज चल रहा है और कार्यक्रमों का सिलसिला लगातार जारी है। नमस्कार।
I think it's coming from the DD feed.
That DD is coming.
I think it's a Doordarshan feed which is sort of.
I think you'll have to unmute again.
I think everyone has been unmuted. If everyone can again mute themselves.
Arup, you may ask your question, please.
All right. Dr. Nageswaran, good fiscal and GDP numbers today. Congratulations to you and all the policymakers. Sir, I just wanted to ask, while you have, in your slide, you have explained in detail how private sector investment is coming back. Now, gross fixed capital formation in real as well as nominal terms has shown a healthy growth. So, how much of that is due to the private sector investment coming back in Q4? And secondly, consumption growth, private consumption has not been as healthy as in Q4 as one would have expected. What could be the reasons for that?
Arup, I must say that there was so much of noise in the system that I couldn't hear your question. I know that.
Okay, there is still disturbance, sir.
रोज फ्रेम क्यों चेंज
I think others.
ओपनिंग लाइव करेंगे हम लोग दिस इज द गेस्ट फ्रेम
Someone is speaking on this.
Come on.
Ma'am, can you ask the admin to mute everyone?
Can you ask the admin to mute everyone except the person who's asking questions?
Yeah, or just mute everybody and the person who's asking will unmute himself.
No, but that won't be possible because once it's muted by the admin, then.
Okay, Arup, now you are somewhat clearer. Please repeat the question.
Okay. Sir, Dr. Nageswaran, my first question is on investment. You mentioned in details in your presentation how private sector investment is coming back. And gross fixed capital formation showed a very strong growth in Q4, both in nominal and real terms. So how much of that was due to this increase in this bounce back in private investment as you were talking about? And secondly, sir, private expenditure has not been as good. Private consumption has not been as good as per the data in Q4, and especially also in FI compared to like FY22 and FY21. So what could be the reasons for that, sir? Why has private consumption been so tepid?
I mean, look, first of all, we always know that Indian quarterly data are not seasonally adjusted. The overall trend in the capital formation and the private consumption are good, and the breakdown between public and private sector capital formation will be available to us when we get the first revised estimate for capital formation in February 2024. But what we can see from the bottom-up corporate data is that private capital formation has been picking up, and its share of overall capital formation would therefore be rising. And that is the most accurate statement I can make at this point.
All right. Sir, grateful if your presentation can be shared with us.
We'll be doing it, Arup. Now, Shishir can ask the question. Shishir Sena.
Yeah, good evening, sir. Shishir here. So my question is that during this first quarter of current fiscal, we are seeing unseasonal rain, which is going to affect the overall agriculture sector. How do you see this kind of risk on overall GDP? Because agriculture is indirectly also supporting services and industry in terms of rural demand.
What is the risk we are seeing? Sorry?
In terms of agriculture, because of the unseasonal rain in the month of April and May, agriculture production is going to be affected. So since these are indirectly supporting the industrial and the services sector, so how do you see this kind of risk, sir?
No, first of all, this April-May is actually the period between the two crops. And in terms of sowing, we showed you that in terms of seed availability and in terms of procurement and also the sowing for the Kharif crop, all of them are looking good. And these unseasonal rains have not been significantly large enough, especially during this intermittent period, for them to have a material impact on the agricultural sector. So right now it is just a speculative question. There is no real basis to assume here that the rainfall has been significantly large enough to damage the sowing prospects or therefore hence the potential harvest in the kharif crop.
Sapna Das.
Thank you, ma'am. Thank you, sir. Sir, two to three important observations that you made. A, you indicated that as data is indicating already, on the inflation trajectory, that maybe we could be more closer towards the lower threshold of the RBI inflation framework of 4% rather than the 5% and plus levels. So could you elaborate slightly on that, number one, sir? Number two, within this, you also mentioned, I think there's already a kind of a soft landing on inflation. So you expect this trend to continue in the current financial year. And second, sir, sticking neck out on the evenly balanced risk for 6.5% estimate for this year. I think somewhere you also indicated that maybe we could actually be higher than the 6.5. So these two questions.
No. First of all, I don't know what to elaborate on the first question on the inflation. I elaborated quite well as to why we expect the inflation rate to trend towards 4% based on the expectations of international commodity prices and also the adequate availability of buffer stock and the production of agricultural commodities in 22-23 and irrigation and reservoir levels, etc. So we explained quite a bit of our rationale for expecting the inflation rate to keep trending towards the RBI's target level rather than being on the upper end of the band of 2 to 6%. So I explained that already. And as far as I didn't say that I expect that the final real GDP growth number for 23-24 is more likely to exceed 6.5%. That is not what I said. I simply said that the balance of risks is now more even than what we thought 4 months ago.
So just one more thing, sir, 5.2%, I don't want to bring RBI into the picture, but that's one big indicator there. So they have said 5.2% is the expectation as far as CPI FY24 is concerned, the entire year out average. So as per your indications, your observations right now, we could be slightly lower than that. I'm not trying to get into government and RBI.
RBI's figure is an average for the year. As I said, we'll be trending towards 4% in the course of the financial year.
Prashant Sahu.
Sir, my question is that since we have got a higher growth than everyone was expecting, so do you think that will put pressure on the next year, this year's growth rate? And the second is about the private consumption expenditure. So how do you see panning out this year?
On the private final consumption expenditure, what do you see? Sorry?
How do you see it panning out during the course of this year?
Again, I think whether the better than expected number for 22-23 will weigh on the 23-24 numbers. It's important to take into consideration the momentum, and we showed enough information about the momentum in the purchasing managers indices, in credit growth, in private sector capital formation, and in the revenue collections of the government, therefore auguring well for its ability to maintain its capital investment plans, etc. And if anything, as I said, we projected a lower growth rate of 6.5% compared to 7%, which was originally estimated for 22-23. And right now, I mentioned that we don't see the risk to the 6.5% as weighted towards the lower side. And we just now said that the risk of 6.5% are evenly balanced. So in that sense, we, if anything, are upgrading our assessment of the growth outlook and the confidence we attach to this number rather than downgrading it. And as far as the private final consumption expenditure is concerned, I did point out that there are signs of a turnaround in rural demand. Urban consumption demand is doing quite well. We presented several indicators there. And with the expected pickup and already happening in the residential real estate construction and the overall industrial activity, employment of labor which have migrated to rural India will return to urban India, and therefore income transfers to rural India should also happen. And therefore we are confident that private final consumption expenditure growth will be respectable for 23-24.
Siddharth from Money Control.
Hi, sir. Just a couple of questions. One, again, having to return to private final consumption expenditure. How do you reconcile the fact that it's increased by only 2.8% in Jan-March year on year, even though sectors like your trade and hotels has increased by almost 10%, construction is up almost 10% if I remember correctly. So where exactly, why is that not perhaps reflecting in private final consumption?
It is.
Second.
Yeah, it is. Yeah, please go ahead. Please go ahead. Sorry.
So the second question is regarding the GVA growth, which is 6.5 and GDP is 6.1. That should imply that net indirect taxes have contracted, but GST collections are very robust, grew very robustly in Jan-March. So if you could just perhaps explain where that GVA, that discrepancy is coming from. Thank you.
We'll have to get back to you on the second question, where the GVA growth rate of 6.5 and 6.1 on the GDP side. Again, I have to mention to you that the India's quarterly numbers are not seasonally adjusted, and the same answer applies to the your question on private final consumption expenditure slower growth in the fourth quarter of 22-23 at 2.8%. Overall, we have also shown you granular indicators of monthly data of how consumption indicators are doing.
Karishma from Business Today.
Ma'am, thank you. So my question has been answered.
Thank you.
So Anchal Magazine.
Yeah, sir, two things. Manufacturing numbers seem to have been revised for the earlier quarters. For the full year now, it is looking at 1.3% as against 1.6% earlier. So if you could tell on that bit. And the secondly, Q4 GDP numbers in nominal terms, are lower than the previous quarter as well as year on year. So if you could elaborate on that also.
Nominal GDP for the year as a whole is 272.4 or 272.5 compared to originally estimated 272.04, and nominal GDP growth is 16.1% compared to 15.9 for the financial year as a whole. And we have also, in response to the previous questions, I have said that quarterly data are not seasonally adjusted. And as far as your point that manufacturing appears to have been revised lower for the overall financial year of 22-23 based on the previous estimates, is that what you said?
Yes, because it was earlier coming out to be 1.6, it is now 1.3.
Again, I think we do have three more revisions to come for the financial year 22-23. So most important in that sense is the reversal in the contraction that we witnessed in Q2 and Q3. So a 30 basis point or 20 basis point revision this way or that way doesn't constitute an area of concern.
So can we end this now?
Yeah.
Now that we don't have any other questions, I wish to thank you, sir, and also all the media persons who have joined us virtually. Thank you.
Thank you, friends from the media, for participating. Have a pleasant evening. Thank you.
Thank you, sir.
And we will share the presentation with you.
Thank you, sir.
Hello and welcome to Business Today Television. I am Siddharth Zarabi, and with me today here at the BT Studios at Goa Fest is Ravi Santhanam, the Chief Marketing Officer of HDFC Bank. Welcome, Ravi, to the BT Multiverse, as we like to call it, part of the India Today group. And thank you very much for your time, because interesting time to be having this conversation. 3 years of disruption, all manner of disruption, and for you